Good afternoon and happy anniversary to Sprott School of Business. And the first thing I'd like to do is welcome back our namesake to campus, Eric Sprott, and to thank him for making our Sprott School what it is and for making our anniversary special. And I'd like him to wear this during today. Welcome to all of you. This is a red letter day for Sprott School of Business. It's our 10th anniversary. That means that 6 classes have gone through since the school was named, and those students have done incredible things. Among our graduates are people sitting in the audience, people like Tony Tattersfield and Ron Jackson, who are leaders in our community. There are people who are sitting right now on Parliament Hill, like Rafika Sitsabasin. There are people leading museums like Patrick O'Reilly, and there are people leading major corporations and businesses like Eric Sprott. Our students today are doing a wonderful job. This year in the Jeux de Commerce, they placed 2nd overall in Canada, and they won 8 awards, including the first in market managing. They won 3rd place academic in the MBA Games. They were finalists in the CFA Investment Challenge. They took 2nd place in the accounting competition, and they were finalists in the international competition for the strategy case. They also won the nickel competition this year. We have fantastic students. Let's give them a round of applause. But fantastic students need fantastic teachers, and we have them at Sprott School. They have done research, and they are doing research in areas of incredible importance. What really marks our school is that we don't just have a Bachelor of Commerce, Bachelor of Business, MBA, but we also have a PhD. There are very few schools in the country that do, and that means that we do research and believe that research is important. And we have a number of research units in the college. One on IT, organizations and people, one on women, infrastructure, manufacturing systems, technology management, social enterprise, internationalization. We have faculty who are doing really impressive research in finance and markets. Professor Ochiri, Mr. Sprott, he might be here and ask you a great question. Professor Saka in the same area. We have Louise Heslop, who's working on branding and who did a wonderful paper on branding of the Olympics in Canada and why it didn't work for China. We have Professor Roja Mendez in advertising and behavior. We have organizational diversity, Professor Dyke. We have incredible faculty who really are doing groundbreaking work that's of significant importance in our country today. Great students, great faculty, need a great leader. And Jerry Tomberlin, our dean, is indeed that leader. Now, his field is statistics. And he has an MA and a PhD from one of those schools in the States called Harvard. And he did a little detour on the way and did a Master of in biostats at Michigan. So he knows what counts, and he knows the measure of quality. So it's no surprise that he's heavily involved in accreditation of business schools across the country. It's no surprise that he's led the way in finding new areas for the business school in which the business school can shine. And it's no surprise that he's actually managed to figure out how very best to use the resources that he has at hand. I am very proud of our business school faculty, students, and the dean. So happy birthday. Now, this is, when you celebrate the Sprott School, you actually celebrate all of Carleton, because one of the wonderful things about our business school is the way they have reached out and embraced the rest of the university. First thing they're doing They're teaching every other faculty how to be entrepreneurial, and they're offering entrepreneurship diplomas and minors to students in every other faculty. A really great outreach. They are building programs with public affairs. They're building programs with science, with engineering. Very, very strong leadership, and they're working with the community to create jobs in the community and new companies, and we're very proud of that. We're very proud of faculty members like Chris Waddell, who's going to be the Master of Ceremonies today, who is in our journalism faculty and the head of the school. So it's another collaborative venture when one school helps celebrate the anniversary of another. So without further ado, I will ask Chris Waddell to come to the microphone and get the show going.
Thank you very much, Roseanne. And yes, it's a particularly timely day, I think, to be talking about the world economic crisis as we see today's multi-100-point move in the stock market, up this time rather than down, but it's becoming almost a daily occurrence. I'm sure we'll hear from all our panelists about that and many other things as well today. Before introducing them, let me just take a second to explain what's going to happen this afternoon. Each of the panelists will speak for approximately 15 minutes. At the end of that, we'll have an opportunity for people to ask questions. I can't see them from the lights, but I think there are microphones on both sides. We'll get back to that after our panelists speak, and then we'll have a bit of a reception afterwards, and we'll wrap up the formal session just a little bit after 3 o'clock. Let me begin, though, by introducing quickly our 3 panel members in the order in which they're going to be speaking. First of all, John Budden, who many of you may know from his daily business programs on CFRA and also his weekly Sprott Market Insights program. John's spent almost 50 years in the investment advising business in Europe, in the United States, and for about the last decade or so in Canada, where he spent much of that time tracking global investment trends and opportunities, and I'm sure he'll be speaking about some of that today. Ian Gordan is chairman of the Longwave Group and has been active in the financial world since the early 1980s. Many of you may know him for his work with his publication, The Longwave Analyst, his Longwave principle of analyzing economic cycles and predictions based on applying that principle to the things such as the end of the bull market, the rise in the price of gold, and the current global crisis. He's also, at the moment, spending a lot of time, obviously, as is everyone else, trying to figure out what's going to happen in the future and applying some of the principles he's used so successfully in the past to advise both retail and institutional clients. Finally, Eric Sprott. I don't think I need to say much here in the way of an introduction for him. Most of you know of his success since graduating from Carleton. I remember sitting in Alumni Park in the hot summer day in 2003, listening to him describe a little bit of his life at Carleton and his life after Carleton as he received an honorary degree from the university. He has more than 40 years of experience in the investment business. He's a legendary figure in the Canadian investment world for the success of Sprott Asset Management and for his prescience, his ability to accurately assess what's happening in markets and as a result figure out what's going to happen as well, and also for his convictions, backing up those predictions with investing action that's made Sprott funds extremely successful. You're probably right to conclude that there's a couple of common threads among our panelists here today. One is their extensive investing experience and the success with which they've, and also the second one that's just as important is the success with which they've challenged conventional wisdom, in some cases quite enthusiastically, and challenged it in lots of different ways. And I'm confident we're going to hear a lot more about both of those things today. So we'll start with John Budden.
Thank you. It's an honor to be here with my pals Ian and Eric, and you're going to get a bit of a wake-up call. And it's really wonderful to be here for this celebration. Now, I woke up at 4 in the morning, I have to admit, and I heard this incredible humming. And it reminds me of the story of Ludwig von Mises, the economist, the Austrian economist, who in 1923 was consulted by a delegation because they wanted to stop the hyperinflation. And he said, I want you to meet me at midnight at a certain address in Vienna. And they were baffled by this, but he was so brilliant that they met him. And he said, listen, can you hear the humming? and they listened, and he said, "Stop the humming, and you will stop the inflation." And they were next door to the printing presses for the currency. And actually, Austria did stop the printing earlier than Germany, and it actually worked. The three horsemen, maybe, you know, Eric and Ian and myself, we're the three horsemen of Kondratiev winter. Now, I'm not sure whether people know about Nikolai Kondratiev, but he was a Russian economist who was born in 1892 and in a farming community, and through a lot of hard work became preeminent. And he, in 1925, published his Longwave theory, and I'm not going to get into that because Ian is Mr. Longwave, and he's going to go into that. But Kondratiev, along the way, offended Joseph Stalin. He was a political threat, and also Stalin did not agree with his Longwave theory. And he was imprisoned in 1931 and executed by firing squad in 1938. His work was taken up by Joseph Schumpeter, who was a renowned Austrian economist who spent a lot of time at Harvard. And Schumpeter really determined that Kondratiev's work was the best cycle work. And then Ian Gordan has taken the baton, and he has done incredible work on Kondratiev's long-wave theory. So about 2 years ago, my friend Dean LeBaron, who founded a firm called Battery March in Boston, and called me and he said, "I want you to come to the Contrary Opinion Forum in Vergennes, Vermont, and I'm giving a presentation with two other people on Nikolai Kondratiev, and I want you to be in the audience and you to impersonate Kondratiev." So at the designated time, I took my cue and I said, "I am Nikolai Kondratiev, Nikolai Dmitriev Kondratiev. I am here from economic underworld to set the record straight." And they said, "How did," Kate Welling, who was the moderator, brought me up to the podium as Kondratiev, and she said, "How did you get here? From economic underworld." "Oh, he's Kondratiev." I was Kondratiev. I said, "Oh, I was consulting to Goldman Sachs, and they brought me here. They have the way to get me here from economic underworld." So this, simplistically, is my idea of the Kondratiev wave. I keep everything simple and in big picture terms. And Ian will take over, and he'll explain the K wave to you. Ian and Eric, as you know, are both very successful money makers, which is quite unique for people who talk about economic things. But Eric, of course, is a chartered accountant. I like that designation because the numbers have to add up. And right now in this world, the numbers don't add up. And the people are slipperier who are running the show than Bernie Madoff. Could we run this, Stephanie and David? Now, I'll take you back to Weimar, Germany. And whenever I talk about this on CFRA, people think I'm off my rocker. But my sense of what's going on now is that we're in about 1920 of that, and it could be much worse once this thing comes to fruition. And I don't know, Ian may give us some idea on the timing, but my guess is 10 to 15 years before the final implosion, maybe sooner. This is a 1 billion mark note, which was walking around money by 1923, 1924. By the way, if you look at that chart, one mark after the First World War bought you one gold mark. And by 1924, it took 1 trillion marks to buy one gold mark. Now that's inflation. And it comes from exactly what's going on here. And by the way, what you heard Nigel Farage go on about is going to back up into the United States, because there are derivatives, there are all sorts of nuclear weapons, as Warren Buffett calls it, financial weapons of nuclear destruction in the background. This is as an estimate. Since the Federal Reserve Board was founded in 1913, the US dollar is probably about 2 cents in value. And I heard the other day that there's a gas station in New Hampshire that will sell you a gallon of gas for one pre-1964 10-cent piece. So that gives you an idea about the value of money. Now, this is what's happened to the money supply. 1971, Richard Nixon had to close the gold window. Basically, you couldn't turn US dollars in for gold. And I hear that he made a telephone call to King Faisal of Saudi Arabia before that and said, I will protect your family and they will remain in power just as long as you price oil in US dollars. This is a great quote from The Sun Also Rises, Ernest Hemingway. And that's where we are now. The numbers don't add up. Any severe increase, that is a doubling in interest rates in the United States, will make the United States officially bankrupt. This is another chart. This is just to give you sort of big picture perspective as a warm-up to both Ian and Eric. And you can see what's happening to the debt level. By the way, on one day in 2008, there was an infusion of $1.7 trillion into the markets to help the banks, and I think that's the equivalent to Canada's GDP. So in one day, they pumped the same as our GDP into the US to help the banks out. And you know what this is about. And they're all complicit, they're all working together, and this is not going to end well. All currencies are racing towards the bottom. There's a trend, the trend is your friend. And so people say, oh, but gold's going up. No, it's not that way. It's currencies are going down. Now, just quickly, I'm going to give a little bit of a rant on the institutional money management business. I'll start in this country. When I first came back to Ottawa, I remember going to a CFA dinner, and people asked me what I liked, and I said I like gold, and they just about laughed me out of the place. Gold was $250 an ounce at that time. It is now $1,740, around that, 50 today. And I don't think there's any institutional money manager in this country that has a track record that matches that. And I think that the denial and the stupidity is going to make it very difficult for people who are pensioners, and that in the people who are a bit younger than I am had better be looking at jobs with Walmart for their retirement years. Had you, in the past 10 years, held cash or degrees of gold in your portfolio, which shows you, the picture tells you what it's about. And again, to my point, when pension funds in this country, endowments, end up having 30% of their portfolios in gold, and I see all of these financial people, particularly the US Federal Reserve Board. By the way, Mariner Eccles, who was a Fed governor, going back, I think, 1930s, 40s, used to say the job of the Fed was to take the punch bowl away when the party was getting going. Well, they're just adding stimulants to the punch bowl, alcohol, and they're probably pissing in the punch bowl as well. That's what's going on. So, surviving contractive winter, I'm going to leave it to these guys, and I trust Eric's judgment implicitly. He's one of the few money managers who's got a grip on this, and I wish all of you the best in the next 15, 25 years, and I would suggest that you take a careful look at your portfolio, and you probably have some gold and some silver, and Eric's the guy to tell us about silver. And on that cheery note, I'm going to hand it over to Ian, and I hope I haven't gone over my time limit. Thank you very much.
Well, thank you very much for having me here. I'm very happy to be here. Probably you won't be as happy to be here after you've heard my little talk. All right, John was just talking about the Kondratiev cycle, so that all my work has been developed from the Kondratiev cycle. I'm proud to say that I've taken it far beyond, I think, that Nikolai Kondratiev ever envisioned it could go. And I've been able, as a result of that, to actually forecast with a fair degree of accuracy how the future financial world will unfold. So the Kondratiev cycle is 60 years in length. And it's been divided, and this isn't my original sort of division, but many people who've written on the Kondratiev cycle have divided it into the 4 seasons of the year. And I think those are quite appropriate. So each season is approximately a quarter of the cycle, or about 15 years. The first cycle, and this is from Nikolai Kondratiev's work himself, begins in 1789 at the dawn of the Industrial Revolution. So that's the first spring. Now, spring is the birth or the rebirth of the economy. And when we move into summer, we move into summer, that is the inflationary period in the cycle. We've always had a war in the summer, and that war, and we're talking about the US, but Kondratiev says the Kondratiev cycle is unique, is basically a worldwide phenomenon. But that summer in the US has always been, there's always been a war, and it's always been financed with excessive money printing. So we've always had inflation. So in the first summer, it's the War of 1812. In the second cycle, it's the Civil War, the US Civil War. The third cycle, the 1418 World War. And in the fourth cycle, the Vietnam War. So summers have always had a massive inflation during the Kondratiev cycle. And that inflation peaks at the end of summer. That brings you, and those are the spring and summer, the 2 periods in the cycle that the economy advances. And once you get into autumn, and we'll see how we recognize when we get into autumn, once you get into autumn, you go into what I call the feel-good period, but it's the plateau period. It's the economy starting to flounder as autumn starts to take hold. And then once we leave autumn and go into winter, winter is when the economy dies because debt has to be wrung out of the system. These are interest rates, US interest rates, put around the Longwave cycle. And the one thing I just want you to notice on these interest rates is where you get these interest rates peaks. Here, 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 and here. Those peaks in interest rates always occur at the end of summer. And the important thing about that is that those peaks are one of the indicators that you're going to go into autumn, the autumn of the Kondratiev or Longwave cycle. And the autumn is the feel-good period because it's the time when people make excessive amounts of money in stocks, bonds, and real estate. It's the biggest bull market of a lifetime during the autumn period. These are prices, PPI, Producer Price Index, and then the CRB, and you can see the same thing occurs. The price peaks at the end of summer. You get these price peaks at the end of summer, so that's your second indication. Peak in interest rates, a peak in prices, that you're now going into autumn. And if you recognize even those two, you know that that's the time when you can go and buy stocks with gay abandon because you're going to do extremely well. Because here we can go back and look at this peak here in 1921, and we know what happened between 1921 and 29. We had the roaring bull market of the 1920s. These are stock prices set around the Longwave. And again, these are the big autumn bull markets that you can see. So we know, again, we peak in interest rates, a peak in prices. Actually, there are two further indicators that tell us when we're going into autumn. One is the recession. You could probably, some of you, I don't guess, a lot of you might not remember the 81, 82 recession and how bad it was. Or you go back to 1920, 21 and recognize people at that time, that recession in the United States was considered to be a depression, it was so bad. And the fourth indicator that you're going into autumn is the bear market in stocks. So you had the bear market 1980, 81, 82, when the Dow went just from above 1,000 down to 777 in August 1982. So those four indicators are telling you that you are going to go into the biggest bull market in stocks of your lifetime, because this cycle is a lifetime cycle. It's 60 years. Well, you don't make any decisions in the first 20 years of your life, financial decisions, or you probably shouldn't be making them anyway. So with those four indicators, we know we're going into this massive bull market, stocks, bonds, and real estate. And this cycle is an investment cycle, and we'll show that very quickly at the end. When that big bull market ends at the end of autumn, it tells you you're going into winter. And that's when the economy dies because debt has to be wrung out of the system. So the big bull market here ended in 1873, here actually in 1837, and here in 1929. That peak in stock prices was indicating that you were going to go into the winter of the Kondratiev cycle. And this peak that occurred in the Dow in January 2000, when the Dow hit 11,750, was the peak in stock prices. So at 2000, January 2000, we could be pretty confident that we were going into the winter of the Kondratiev cycle, into the payback period when debt has to be wrung out of the system. What's happened in this period, in this cycle, our fourth cycle, the Federal Reserve has done everything it can by printing more and more paper money to try and thwart the Kondratiev winter, so that we've had this first bear market, 2000 to 2002, then Greenspan brought down the rates from 6 to 1%, flooded the banks with money, got the thing going again, so up she went again into 2007, and all that money reignited the stock market, also created a massive bubble in the real estate market in the United States. And that the chickens have come home to roost on that one there, and they're going to come home to roost here fairly shortly. So we're now in the third attempt to revive this stock bull market by continually printing paper money to get it going again. Where is the bear market likely to end? Because that's the question you have to be asking yourselves. Well, we know that this bear market took the Dow between 1929 and 1932. The Dow peaked in September 1929 at 381 points, and it ended in June 1932 at 41 points. More importantly, what you can see here is the Dow ended below the point from whence the 1920s bull market had begun. And so if we were to emulate that again, and by the way, bear markets are always a mirror of the preceding bull market. The bigger the bull, the bigger the bear. I mean, we just have to accept that. That's always happened. So that when this bear market resumes and the Federal Reserve runs out of any further ammunition to keep it going, we're going to go down. And the target that I've picked for this bear market is Dow 1000. But if we are to go below the point from whence this bull market began, we would be down below 777, because that's where the bull market began. So we would be down somewhere near 500. So you have to ask yourself, what does that mean? What does 500 or even 1,000 on the Dow mean? It means a catastrophic depression, an economy that basically isn't functioning. Between 1929 and 1933, the US economy dropped by 45%. So you've got about a $14 trillion US economy today. You can see that if we drop by 45%, and I suspect it's going to be a bigger drop this time, that even if we drop 50%, the economy drops down to about a $7 trillion economy. Unemployment between 1929 and 1933 in the United States was 25%. It was apparently even higher than that here in Canada, over 30%. So these are the kinds of what a Kondratiev winter is all about. It's washing debt out of the economy, and that is very, very crippling both to the creditors and the debtors. The debtors go bankrupt, and the creditors go bankrupt because they can't be paid back. Here we see gold, and we've used a gold stock price. And you say, well, that's not fair. Well, we have to use a gold stock price. In this case, it's Homestake Mining, which is one of the original stocks listed on the New York Stock Exchange, because the gold price is fixed, because we were on a gold standard system until 1931-33, when the whole monetary system of the world collapsed, and we're going through that same collapse in this current long-wave winter, the same monetary collapse that we felt in the 1930s when the whole system stopped. Britain got forced off the gold standard in September 1931. Austria was bankrupted in May 1931, and the whole monetary system of the world collapsed between 1931 and 33. The US, the mighty US, the greatest credited nation in the world, very little debt, was forced off in 1933, forced off the gold standard system. So there was basically world trade dropped by 75% because there was no means of payment. No one would accept anybody's currency. And a new monetary system didn't evolve until Bretton Woods in 1944. So what we see here is we've used Homestake because until 1971, when Nixon went off the gold standard, or tied the American dollar to gold, went off that in 71, August 1971 at $35 an ounce. So we've used a gold company's price. And what we see here is that gold performs exceptionally well in the inflationary summer, when we have the war paid for in heavily printed dollars, and very, very well in the deflationary, depressionary winter. Here's Homestake, here's the bear market, and here's Homestake, and you can see that it goes up by 600% between 1929 and 1936. Knowing this, in 1999, 2000, I was just returned to being a stockbroker. At that time, I'd been on the management side in the business, so I had to get myself some accounts and to build my account base. So I knew this, and basically I turned all my assets and all my clients' assets, those that would give me their money, into gold and gold stocks. From 2000, nothing in the general stock market, because the Kondratiev winter is telling us that we're going to have a massive bear market in stocks, every bit as bad as the 29-32 bear market, and probably a lot worse. Finally, this is the problem. It's the debt. It's the debt stupid. You know, I wrote a paper emulating who was the president, or trying to become President Clinton. When George Bush, there was a slight recession going on, so his advisors said, just keep hammering on the economy when you're talking about George Bush's record, because they were in a recession. So they wrote on a piece of paper, it's the economy, stupid. Well, it's the debt, stupid. This is what brings down the whole system. And you can see here, this is the US debt per GDP. And this big blip up here in debt is between 1931 and 33. Why? Because GDP has collapsed. So then we go down, and debt bottoms right at the beginning of spring of the long wave cycle. You can see the bottom right here. So debt bottoms at the beginning of spring. Debt is being washed out, and then it starts to grow. But where is the big growth in debt? It occurs in the autumn of the cycle. That's where you get, and we've seen debt per GDP here double since 1980. So in the United States, so we're over 350% of debt per GDP in the United States. Total world debt today is $219 trillion and has been growing at the pace of 12% a year for the last 9 years. The economy, the world economy, has been growing at about 4%. So debt is outpacing the economy 3 to 1. You cannot continue to basically have those kind of conditions cannot be allowed to continue. And now we're seeing the whole debt bubble of the world starting to collapse. We're seeing it in the euro, but they're going to fight mightily to preserve the status quo, but they will fail. Markets are governed by natural law. So I end my presentation to you. We've done 240 years of financial and economic history here in about 15 minutes, which is the time that I've been given. But you can see how accurately, if you understand where you are in the cycle, and you can know where you're going in each of these seasons, and I showed you how to get in, how we knew we were going to go into autumn. I showed you how we knew we were going into winter with a peak in the big autumn bull market in stocks. We know when we're going into spring because there's a recession in 1949 and a bear market bottom in stocks in 1949. And we know when we're going into summer because the big bull market, there's a bull market in the spring. Why? A bull market in stocks. Why? Because the economy is being reborn. It's starting to gather momentum because people have got savings. Economies are driven capital through savings and not through debt. Thank you very much.
I love going after Ian because I'm going to be the good guy, okay? Kidding. Very proud to be here celebrating the 10th anniversary. Very proud of the accomplishments that the business school has made. And thank you, Roseanne, for highlighting those, and Jerry for creating such an environment for everyone, including the PhD and the other interesting courses and studies that are going on. And I was particularly interested when, I think it was Roseanne said somebody won an award for market managing. Oh my God, he can get a job with the Government Bank of Canada or the Fed or Goldman Sachs. Market managing. It's exactly what we need. I really should explain to you why I invited Ian and John to be here. You're probably thinking, how could that guy do it to us, right? And there was a little method in my madness. As you know, I tend to be a little controversial or unconventional. And the reason that first of all, I've known these gentlemen for quite a while now, and I'm very happy that John has the Sprott Market Insights program here in Ottawa, and I hope everybody listens to it on Friday night, but I bet you kids don't. There might be a replay on Sunday, you never know. But I've respected what they have to say. They have been incredibly accurate, and I wanted people to hear it from a different side. You live in a city where probably everything's going to be okay all the time because that's just the way they got to tell it. But you know, it has not been okay. And I want to get into a little of why it's not okay. And I do apologize for putting it this way, but I think there's important things that people can do to survive the crisis we're in. And that's really what the message is here, that, you know, there are things you can do. There are ways to survive, and I would like this group and others around you to survive that. So I don't know how many people study the banking business, but the banking business is a levered business, where a bank, for example, will have $1 of paper assets, all these assets on the left-hand side of this inverted pyramid, and down below, you have 5 cents of capital. That's if you're levered 20 to 1, you have 5 cents of capital supporting $1 of paper assets. The conventional thinking is that the European banks are levered 30 to 1. All you have to think about is if that dollar of assets falls by 5 cents, the bank has no equity. And just imagine in Europe today, you have stocks that are down 25%, you have bonds that are down 20%. There is no way that they have any capital today. There is no way. And that's why all the money was leaving the European banks. It's quite documentable exactly what was happening. People aren't stupid. They're not going to leave their money in a bank that's broke. And if there's one thing I would like to have you come to think about, if not react to, is that having your money in a bank is a risky investment. And I term it that way. It's an investment. You are betting that that bank's good. But the logic says it isn't, because of the leverage that these assets are so volatile. And they're so volatile, and of course today we have all these central banks come in and announce they got some new program to support the world. Why? Because the system was about to break down yet again. And I'll remind everyone that 3 months ago, Dexia Bank, was a very large bank, was the highest rated bank in the European stress tests, and 2 months later was poof, gone overnight. That's what happens in banking. I don't really need to deal with the problems in Europe. I mean, the problems in Europe are so overwhelming, and that's why what you saw happen in markets today had to happen, because the money was fleeing the banks. Just imagine you're living in Greece, and somebody talks about they'll get kicked out of the euro. Well, you're going to want to leave your money in a Greek bank and end up with Greek drachmas? You know, or you're Portuguese, or you're Spanish, or you're Italian now. And you're worried about, you know, you're going to get kicked out. What do you think you're going to do with your money? So the problems are extensive. And the way of best explaining it, this is a chart of what's called credit default swaps, a very evil creation of Wall Street. And this shows what the cost of insuring government debt is. And the thing that I really want to point out is you can see in the 08, 09, when we had the last crisis, how little it cost to protect sovereign debt. And look at the cost today of protecting sovereign debt. We've gone from a crisis that was sort of in the private domain in 08, 09, i.e. Lehman Brothers, Bear Stearns, whatever, Fannie, Freddie, all that stuff, to now a sovereign crisis, where people are unwilling to own sovereign debt. So basically, Ian and John have covered off, you know, where we think the world is going, and I don't need to dwell on it much anymore, but I just want you to all think about where you have things invested. And I have a couple of issues that I want to bring up because I'm at a university that I'm very proud of. But there are issues here, they're not specific to Carleton. There are issues with universities. And the first issue is, this with any university, anywhere in the world, is that the underfunding of the pension plan. Pretty well all pension plans in the world are underfunded. And we get no return on our investments anymore because the stocks have done nothing for 11 years. And the interest rates that might have been 6% back in 2000 are 2 or 3 now in the US. And how do you get a return in your pension plan? So I'm just suggesting to those of you who are looking forward to your pension to plan very wisely, because the odds of it being paid, I mean, just be realistic about it, okay? You can read about, for example, the Canada pension plan or the OMERS pension plan. What do they always say? We're underfunded, we're underfunded. Well, you can't keep being underfunded. Something's got to give, so be aware of it. And I wanted to talk about the business courses that are taught, and I'm, again, not specifically talking about the Sprott School of Business, but I pointed out here there was a bit of a revolt at the Harvard MBA school. This is about 2 weeks ago, when the students boycotted the class of Professor Mankiw. He's a very well-known economist. And why did they not go to class? Because they said, you know what? You've been teaching us the same crap for 40 years, and it doesn't work anymore. You keep telling us about Keynes and all that stuff. It's not working. We're going to come out of this school, what are we going to know? We're going to go in with the same solution, print money, run a stimulus, everything will be wonderful. We all now know that doesn't work. We had QE1, we had QE2, none of it ever worked. So be aware that there are other schools of thought. There's the Austrian school, which John had referred to, but it's an ever-evolving thing, and everyone has to think very clearly about what is functioning and what is not functioning. The other thing that I have a particular concern about, and seeing as I got the forum I want to talk to it, is student loans. You go to university, you incur all this debt, and all of a sudden you're out of university and it's tough to get a job. So be very careful in your decisions here, okay? I mean, you got to be careful. If you believe 1/10 of what Ian says, you know, the outlook's not good. Don't go too far. Try not to go into debt, period, because debt is just a bad thing. But it's a problem, and I'm surprised that it hasn't fostered more dissent yet. Okay, I did want to make a few comments about, you know, what it takes to be successful. And this, of course, is more directed at the students. And I think by far the most important thing is just to be pragmatic. Take the data you're given and you think about it. Don't take others' opinions of what was announced. I can't tell you how many times we see announcements in the U.S. and it comes out, housing starts were up this month. Okay? Nobody reads the data. They announced it this last month. Housing starts are up. No home sales are up. I look at the data, and this is so typical. Why were they up? Because they revised the previous month down. They were really down from what they had reported the previous month. But you get to say they're up because you revise the previous month down. This happens with the unemployment data all the time. Every time they do a revision, of course, it always looks like we're creating more jobs because they always revise the previous week down. So you have to keep your mind open to these things and see the data and let the data talk to you, and don't accept the given of what we call the spin of the press. You got to think independently. You got to do your own thing. When I think that one of the articles I wrote was Surreality Check, Dead Men Walking, and it was written in I think November of '07. I'm just a guy living in Toronto, okay? And I said, the following companies are broke: General Motors, Fannie Mae, Freddie Mac, Citigroup. They all had big market caps. Well, why would I being so audacious as to say that? Because I knew they were broke. You look at the data. You do your own thinking. It's not that tough to figure out. And I guess on the same topic, you got to be bold. You got to take risks. You'll never get wealthy. Not that being wealthy is important. It isn't important. Having a good life is important. But you have to be bold in life if you're going to accomplish an outsized return. You can't be sticking your money in a bank making 0.1% and find out that the bank was broke anyway. You got to take gambles. And you have to be on the hunt for ideas. And I can tell you that every day of my life, every day, I'm looking for something I can invest in. I'm looking for something unique. I might find 2 paragraphs in some newspaper. I might hear something on the news, or somebody tells me something, not inside information, of course, that I can see something evolving. And you got to keep your mind totally open to that. And I got to talk about the great wealth redistribution. So these gentlemen were talking about gold and the economy, okay? Now I'm going to show you what's happened here over the last 11 years. And this is the performance of gold stocks versus the U.S. bank index. Okay? Now you know the biggest investments that everybody has are in banks. Everybody's biggest investments in banks because it was the biggest part of the market. Look at the performance. The gold stocks were 1,400%, and the bank index is down 56, probably 51 today after the 5% phony rally, okay? Don't get sucked into these rallies, okay? They make these big announcements. The first thing they got to do is make sure those stocks go up so everyone says, oh, it was a great decision. Just like when Europe keeps announcing all these things, then the market roars up, oh, it's a wonderful decision. And then 2 days later, it goes right back down again. But in the meantime, we're all meant to believe that was a great idea, even though it isn't. And this is for example, the performance, what time is this now? This is from, looks like '07 to today, of the European bank stocks versus gold stocks. And I call it a great wealth redistribution. I will be so bold, and I'm going to be totally bold now. Of course, I said you had to be bold, right? I've actually contemplated, and I'm just using the word contemplated, that maybe in the next 10 years, I could be wealthier than Warren Buffett. And how's that going to happen? Because Warren could lose 75% of his money, and mine will go up. And I hope to pass him. That's what I mean about the great wealth redistribution. So make sure you're on the right side of the train. We've already talked about gold, so I don't need it. I mean, gold has kicked everything's ass, okay? No doubt about it. Hate to be so crude. So I hope you get the message, and I apologize for all of us. Well, look at us. We all look happy, don't we? Like in our former lives, we're probably all executioners. But again, I'm very proud of the business school. I wish you all the best of success going forward. And if there's anything that I can do for the school, I always take any calls from people here at this school just to see what I can do. So good luck in the future, notwithstanding our forecast. Thank you.
In the current economic climate, when we're seeing markets go up and markets go down, we're seeing all these things happen, what are the 1 or 2 economic indicators that you're watching to try to figure out what's actually happening and where we're going? We'll start with John and then just go down to 3, and then we'll get to our first question.
I guess what I'm watching is to see if there's discipline coming from any of these official bodies, and there's no evidence of that. And so I can't give you a specific indicator because I'm big picture. I'm not smart enough to do the micro stuff. But as I said about gold, when I see it 30% of institutional portfolios, which was the percentage that institutions had in Nortel 10 years ago, 12 years ago, then I will start to cut down, maybe temper the gold position, and maybe things will be turning the right way. But we're a long way away from any evidence of that.
Ian?
I don't really watch any economic indicators because I don't believe them. I don't trust them. So I'm more watching the big picture stuff too. You know, again, I sort of drew attention to the fact that the world monetary system failed in the last long-wave winter between 31 and 33. So we're watching the same thing playing out here, beginning in Europe. But once Europe goes, and it will go, the euro will go, collapse. Once it goes, the attention will then focus on the United States and probably Great Britain. And you will start to see people, just as they did in the 30s, you will start to see interest rates rising in the United States and in Great Britain because they won't be able to fund their debt. And that's really what I'm watching, is what's happening in Europe, how quickly it's going to unfold.
Eric?
Okay. I probably look at like hundreds of data points, and I'm a bit of a data point junkie, but I think for your purposes, the key thing is to watch personal income. And personal income for the last 5 years in the U.S. has gone down. And it's not difficult to understand if personal incomes go down. You have to shop less. I mean, that's just a given, okay? When the president of Walmart about 3 months ago, he said, our customers are running out of money. I mean, that to me was a huge statement, okay? There's a guy who knows. He sells 25 cents of everything that's done. One other data point that of course, I monitor China very carefully because China is the great hope for everybody, right? And I suspect that China will have a hard landing. And of course, I'm looking for any sign that it's not working in China. And we have signs that it's not working in China. We have the China Purchasing Manufacturers Index that came out for October. It was either October or November. I think it was October. And it showed negative growth. Negative growth. Negative growth. Why do I say it 3 times? Because everyone believes in the Chinese thing. And the data is starting to show that it's got negative growth. Well, there goes that dream. So there's lots of things to look at, but those are 2 of the key ones.
Okay, thank you. Over to the microphone over here.
Carmen Joint, BCom 66 from Carleton. To Eric, I'd like to know how you're going to beat Buffett over the next 20 years. What
Sure, okay.
Invest in?
No, 10 years.
10 years. Oh,
Yeah.
even better.
Well, you know, Warren believes in the system, right? In fact, Warren came to Toronto, I think sometime in 07 and 08, and he said, I believe in America and everything's going to work out. And I thought, oh my God, how could he think that? Because, of course, it was crashing. It was. You know, we were within hours of the financial system collapsing till the Fed and all the central banks came in. So I don't know what he was reading, but, or maybe he just knew that the hand was going to come in, just like it came in overnight. But I suspect that he'll be wrong. I suspect that Ian and John will be right, and that I'll be right, and that typical investments that he has, such as Bank of America, Wells Fargo, whatever else he has, won't do well. I mean, I look at the chart performance of Bank of America, and I bet you any guy in the world who looked at that chart would say, well, we know where that company's going. Because you can't go from 60 to $5 without having a big, big problem. So I'm assuming that he falls by 75%, and that I get some multiple of my net worth over that time that might make up for his decline and get above him by being in precious metal. That's all I'm assuming is going to happen.
Okay, so it's precious metal that
Yeah.
you think will
Yeah.
continue to go. Okay, thanks.
Okay, thanks.
Over here.
Not to mention that he'll probably die in the next 10 years anyway, so.
I think that was a prediction about Mr. Buffett, wasn't it?
Yes, of course.
Okay.
I got a comment for that, first of all. When I was in India about 2 or 3 years ago, I learned the key to great wealth. It's a very simple thing. And I was at the Oberoi Hotel. And Mr. Oberoi, who obviously had amassed a great fortune, there was a plaque there commemorating his life. And he lived to be 105. Oh, jeez. You know, if Ian lives to be 105, he'll be wealthier than Buffett. Thank you, though.
Yes.
This question actually, I guess.
And identify yourself, please.
Okay, my name is Human Lafai, BCom 98. A question I have is for Mr. Sprott. Now, I'm a fan of Mr. Budden's show on CFRA, and I always hear him mention that it's time for investing in hard assets, of course, such as precious metals and other hard assets. Now, we're all sort of anticipating a bit of a real estate correction in Canada. Now, as a somewhat of a real estate investor, my question is, isn't real estate a hard asset? Like, do we not? Don't the wood and the lumber and the tile and everything that goes, all the building materials, are they not a hard asset? So if we're having an inflationary period, wouldn't it make sense that the cost of buildings will go up as well?
Well, it's a great question. I believe that the value of the majority of real estate is a function of interest rates and lending ability. And if people won't lend or the rates are too high, the value of houses will come down, and buildings in particular, right? Or if GDP falls by 40%, the buildings are empty, people don't have jobs. So I think that real estate generally would not do well. I think that somebody could make a case for agricultural land because it's more productive than. So I'm not a real estate investor, and I don't know if any of these other fellows have any views on that. Real estate?
John?
No.
Ian?
No.
No? All right.
Okay.
Then I guess we'll
Thanks
go over
for
to
the
the other
question.
All
microphone.
right, thank you.
Hi,
Yes.
my name is Larry Poirier. I'm a MBA and lifelong entrepreneur. My question is directed to Mr. Sprott. I'm a big fan. I own multiple of your funds. Keep keeping in mind nobody's perfect. I also own the molybdenum fund.
You're not referring to me, are you?
Yes. I just wanted to discuss about, since we can't buy just gold in a diversified portfolio, what are your feelings about investing in certain countries? Which countries do you think will fare best over the next 10 to 15 years? And also, which banking system in which country you feel, because we hear about a lot in Canada about our banking system.
Okay.
Which banking do you feel, if any, is worth investing in?
Well, Larry, I love your question because it takes me to the answer that I'm going to give. And I'm not a believer in diversification. I just do not believe in it. I never have, and I never will. You go the best thing you can do. And if it's gold and silver, it's gold and silver. For my clients, I own 80% gold and silver. For myself, I own 80% gold and silver. I'm not swayed by any of this stuff about diversification. I don't believe it for 1 second. If I was diversified, theoretically, I have some bank stocks, okay? Well, excuse me, I don't want to have bank stocks. I want to try to get the best return in the safest way that I can. So now to answer your question, what banking system is the best banking system? Well, of course, you know I'm going to create a bank, right?
No.
I don't know if this is a leading question,
I wasn't aware.
but thank you for asking. I'm hoping to get a bank license. It's out in the public domain, okay? And I think if you can put your money in a bank that has, I'm going to say, zero counterparty risk, where none of the money's lent out, which I would hope that our bank, that's what it would be. You put your money in gold, silver, or leave it cash, but we're not lending it out to anybody. And I just think that leverage, you know, if you just think of leverage this way, most of these banks have weird investments. You know, we found out that a Canadian bank lost $650 million in natural gas derivative contracts. We found out that UBS, some guy lost $2.3 billion. We don't even know what he invested in. Of course, neither did the bank. And how much do you have invested to lose $2.3 billion? He probably had 10% of the capitals invested in whatever the hell he had invested in, and that's how he lost $2.3 billion. So I don't want to try to direct you to one bank or another bank. I just think banks are faulty because the big thing was they wanted their ROE to grow, so they kept growing the loan book all the time, and they all got too levered. And now, as Ian and John have explained, the debt situation is going to collapse. And when you're banking, you got to sell something, and everyone's selling. There's no buyer. That's the problem. There are no buyers. So I hope I answered your question, Larry.
Yes, thank you.
Okay, thanks.
Just over on this microphone over here.
Hamid Vafoy, MH92. My question is for Mr. Sprott, and there's no doubt that silver and gold should go up given the economic situation that we have, but they also have a psychological value. And if we get into a real crunch, silver and gold would not transfer directly into food. But what's your take on commodities, especially oil?
Well, it depends what kind of crisis we have. I've always thought if we go into some economic contraction, that's a great question, by the way, but over the short term, the demand for oil would fall and the price might fall. But in the longer term, because the price had gone down, and because you're in a financial crisis, the drilling will slow down dramatically. And then the depletion rate, which is incredible in natural gas, is like 30% a year and 10% a year in oil, it's going to catch up with you. And ultimately, I think the price would go back up, but I think you'd have a little bit of tough time in the meantime. So we look at gold and silver as currencies. I mean, that's really why we're there, right? Not that they're commodities, it's because they're currencies. That's the reason. So oil doesn't quite fit in that category in my mind. I happen to own some oil stocks, but I think the more certain outlook is in gold and silver. Thanks for your question.
Thank you.
Let me stop for a second and ask Ian a question, which is, in the United States at the moment, we're starting to see a little bit of an increase in the personal savings rate. It's not as bad as it was before. We're seeing people at least talking about deleveraging. How much deleveraging is actually going on, I'm not as sure. But where are we in the cycle at the moment in terms of the washing out of the debt? And how long do you think that's going to take before we actually move out of that phase?
Where are we? We're only at the very beginning. Because in fact, I mean, we've seen some of the financial debt in the United States has been paid off simply because the Federal Reserve has put so much money into the financial institutions. And we've seen consumer debt being written off in the United States simply because people are losing their houses, so that mortgage debt is gone. But we've seen government debt increasing, and federal government debt increasing quite dramatically. Over $15 trillion now in the United States and growing at about 1.6 trillion a year. So we're only really at the very beginning. If you look at after 1929, it wasn't until 1952 that the debt to GDP reached its bottom in the United States. So this process is, and they're trying to stop the process unfolding. I mean, if Greenspan had allowed in 2000 the whole thing to sort of go then, it would have been a much quicker and less nasty process of debt reduction. But now it's going to be, I think, pretty horrible.
And for lasting how long, any idea?
Well, probably another 15, 20 years.
Okay. Next, over at this microphone over here.
My name is Alexander Bacchus. I'm a BCom Finance 2010. I'm a fairly young guy, so I have a question to Eric Sprott. I'm a big fan. I've been following your work with Casey Research. And you recently had a talk with James Turk about the end of currencies. Maybe you can introduce the room to this idea and also discuss why you think that gold and silver will replace currency, because under the current auspices, under the current ideas of what is a currency, gold and silver don't work, primarily because they're not yielding assets. So maybe you can talk about that.
Well, I mean, you're assuming that somebody comes along and they don't want to say, well, we're going to make gold and silver the currency. But what will happen is people will realize that there's nothing behind the currency. There is nothing. I wrote an article called Surreality Check 2, Dead Governments Walking. And I specifically said the U.S. government, by their own data, is bankrupt. I mean, you can use their data. They have something like 60 or 70 trillion of liabilities that they're aware of, i.e. Social Security that hasn't been funded, pension plans for their federal employees, Medicare, none of this has been funded. And when you put it on a proper accounting basis, the liabilities are 60 or 70 trillion, I forget the number. But how can a country that has 15 trillion of GDP support 60 or 70 trillion of ultimate debt? So the people will lose confidence, and they'll just go to gold and silver. And the central bankers and the government will realize, well, it's got away from us here. Okay, how are we going to finally stop this thing? And we'll have to institute a process where these metals back the new currency, whatever it's going to be called. Hope I answered your question.
I actually have a little bit of follow-up, because I think I agree with your ideas, and sorry for taking up time, but I agree with your ideas, but the fact is the U.S. currency is still the reserve currency of the world. And in the way I see the world is, as long as that happens, they can get away with the printing press.
Well, of course, I don't agree with that, right? I mean, I think that it's the reserve currency of the world till it's not the reserve currency of the world.
Yeah.
And as I said, I think the market's made up its mind that gold's the reserve currency. The market has. Why do we think gold's up 600% when the currencies have all done nothing? The market has made that decision. So I rest my case.
Thanks a lot.
Okay, thanks for the
Yes,
question.
sir, over here.
Oh, hi, I'm Conrad Egan, a financial advisor. Just two quick thank yous. I wanted to thank the Sprott School of Business. This is fantastic. I really appreciate it. And second, I wanted to thank John Budden, the lone voice of Ottawa media, who's been swimming against the stream. If you look at the radio media, television media, or paper media, this guy stands alone. So he's definitely been an inspiration to me.
Thank you.
And my question is to Eric Sprott. Three types of gold: precious metal stocks, and silver. Precious metal, paper, gold, silver, and the real stuff.
Right.
Maybe you could explain the three, please.
Okay.
Briefly.
Well, the one thing you don't want to own is paper gold, where some guy says, yes, you have a certificate that says you have the gold here, because it's not likely to be there, okay? You don't want to buy paper gold ever. You want to buy the real thing, and you got to know that even if it's a vehicle, like the Royal Canadian Mint, I think is legit. You can turn it in. Sprott Physical Gold Trust, Sprott Physical Silver Trust, you can turn it in. There are others that are like that. So you either own it through one of those vehicles, or you own it yourself and you store it yourself and you have access to it yourself. I still happen to be a big believer that the stocks can do incredibly well because their earnings keep going up. In fact, I describe gold stocks now as growth stocks, and I mean it. I mean it in the sense of, you want something to grow. What can you buy that grows? Well, let's take Exxon or IBM or Walmart, okay? What are they going to do in the next 2 years? Well, I guarantee Exxon will not grow because there's no more oil to produce. But you can find lots of gold stocks where the production is going to double in 2 years. There's a 100% gain in 2 years. And if the price of the metal keeps going up, and I'm going to use the example, if it goes up 50% in 2 years, which is about 22% a year compounded, which is about what has gone up this year, that extra 50% will already double the earnings. Now you've doubled the production, your earnings have gone up 4 times. That's what can happen to gold stocks. So I very much like gold stocks.
All right, thank
Thank
you.
you. Thank you for the great comments, too.
Yes.
Hi, my name is Daniela. I'm a current MBA, and I was just, this question is directed at Ian. Just how are you protecting your assets right now? Because you kind of painted a pretty grim picture for the next couple of years, so.
Pretty grim.
Sorry?
How do you protect your assets?
I'm not telling you where I've hidden my gold.
There you go.
Is it in British Columbia somewhere?
But I'm 100% invested in precious metals and precious metal stocks. 100%. I'm like Eric. I think diversification is basically a means to mediocrity in terms of your performance. You can go in the precious metals at this time in the cycle, and you can go into the stocks in the spring and the autumn of the cycle. And we're in the winter. We want to be in precious metals, and they've done extremely well, and they're going to continue to do well because the chaos is just beginning to unfold in the world. Thank you.
Hi, my name's David Malou, BSc 83. A question to the panel. There's no denying the statistics you've put up with regards to the price performance of silver, gold, etc. Could you comment on the multiple compression or the multiple erosion that we've been seeing in the precious metal equities since 2007 and why it has not reflected the increase in the underlying metals?
Well, maybe I should take it first because I'm a little more active day to day in that. And I think people's memories are short. In 08, the stocks got absolutely hammered when there was a crisis, which I think was a mistake. You should never forget that JP Morgan and HSBC are being sued for manipulating the price of silver lower in 08. And I hope that they prove that that was the case. I've read the lawsuit. I see what they have to say. And I've always believed there's a central bank intervention in the precious metals markets. And that kind of chaos that happened then has left quite a deep scar with investors. Plus, we have all these vehicles which are now available to invest in gold, including just recently the $600 million mint issue, right? Where you could buy gold coins or bars or whatever. Well, imagine if the $600 million would have gone into gold stocks. I think it would have been quite different. And it's just a matter of the market figuring out that gold is here to stay, the price of gold is going higher, and if it starts moving up here, I think you'll see a very, very quick spurt in the gold stocks. And it can happen. I mean, these things can go up 50 and 100% in 3 to 6 months. That's what happens. They get in and out of favor. So that's my reasoning.
Yeah, in the 1970s, I had the pleasure of going through that gold market. The really good gold stocks went up 10, 20, some of them 50 times in value. But there was no competition. There were no ETFs. But as Eric said, these gold shares are going to be paying very big dividends, and people are desperate for income. And probably the gold shares right now, because they're in effect undervalued because of this ETF phenomena, are an excellent buy.
Ian, I think that.
Yeah, I'm 100% invested in the junior sector, have been since 2000. And yeah, I took a big hit in 2008, and I'm taking a big hit in 2011. But 2009 and 10 had recovered and went way beyond where I had been before the 2008 crash. You can buy junior gold stocks with 43-101 assets in the ground here in Ontario, in the Abitibi Greenstone Belt, with over 1 million ounces of gold for less than $20 an ounce of gold in the ground. I believe that if you look for stocks like that, they have to go up. They have to reflect the actual value of gold. And they should be trading probably at $100 an ounce of gold in the ground, and you can buy them for less than 20. So those are the kinds of juniors that I'm concentrating on, and there are quite a few in Canada and certainly here in Ontario.
I hope you're right for my portfolio then.
Okay, we've got about 7 minutes left for questions, and I think there's 3 or 4 people there and 1 over here. So if everyone asks their questions quickly and we go through them, we can hopefully get everyone in. So over to this microphone.
All right, so I'm Christian Osher. I'm a student reporter for the Charlotten on-campus newspaper. So this is directed to Ian. In your discussion today, you mentioned the fact that we're in the winter period of the waves, and as such, we need to resolve debt. However, as is shown in the United States and Europe, that's hardly politically expedient. So from your business perspective, is there a way to make debt cutting tolerable to the public, or is debt dealing merely something we have to do and for too long have put off doing it?
I don't see any means of making it tolerable because it's just so massive, the amount that's being, it's far bigger than it was in the 30s, and that whole debt bubble burst in the 30s and created the depression of the 30s. It's much more massive and much more worldwide than it was in the 30s. So I just don't see how it can be nice and easy.
Thank you. Over to this microphone.
Hi, this is for the panel. My name is Anna. I'm an international student at the MBA program. And my question is a bit more global. As you've mentioned, there's been a shift in economical power. The euro is going down. The United States is probably going to go down. How can Canada take this opportunity to become, why not, the currency for the world trade? How can Canada become the leader in this?
Ian, you try that one.
I was wondering who wanted to go first.
Well, I've long contended, I live on the West Coast, and I've long contended that the attention of Canada should have moved to the West Coast. In other words, because the power, the wealth of the world has shifted to the East. And that's where we have to basically start to sort of see where our markets really, where we have to develop our markets. Our neighbor to the south is where we've always been able to sell everything to. They're bankrupt. So they're going to go through a massive sort of, they're going the way that Great Britain went in the 30s. They're going to go, much like Great Britain, to a second-rate power. It's going to take time. And so we should have been shifting our attention to the West, where we're already, because the Americans have tried to cut us off on lumber by imposing duty on our lumber. We're already selling more lumber now into China than we are selling from British Columbia than we are selling into the United States. So I think that we've got to see that the future lies in the East, and that's where we want to concentrate as Canadians.
We live in the best country in the world. Ottawa is one of the best places to hide. And I think, no, I'm not kidding. Pay your taxes, hide in Ottawa, enjoy freedom, and this country has tremendous potential. We have to have a long-term game plan out of our governments. The Chinese, my dear friend Dean LeBaron says, the Chinese plays chess and we're playing checkers. We've got to develop this long-term plan, and we've got lots of grease and rocks in this country, which is nice given the scenario that we've heard, but it's going to come from you guys. I'm talking about the younger guys here who will architect a 100-year plan for this country.
My name's Justin Caravaggio. I have a master's in cellular molecular medicine. Basically, I have two quick questions. The first question is dealing with my demographic, the 20-something demographic, just finished school, $20,000, $30,000, $40,000 worth of debt, you name it, is, to quote James Turk, basically the European central banks, they've been kicking the can down the road, but at this point, the can is a 2-ton boulder. At this critical juncture, is this a time where you can just suggest to someone, even with debt, if they have some extra money on the side for savings, to start putting it into silver at this point?
Okay, and I'm going to stop you at one question, I'm afraid, or else we're not going to get through everyone. So that'll be your question. Who would like to answer it?
Okay. Well, you might be lucky if you got all that debt. Because I suspect you might be writing it off someday. In other words, you're one of the guys that says, I can't pay it, okay? Like, that's probably what's going to happen, because you won't be able to pay it. So maybe I should actually encourage you to take out debt.
I say the debts will be wiped out?
Well, you're just not going to pay it. So everyone will give up on collecting debts because it'll be impossible. But
okay, thank you.
But I do think you should own, if you have money that you can invest in gold and silver, obviously with all the discussion we've had, we think that's where you have to be. So that's what our recommendation is.
Okay, thank you.
Thank you.
Hi, I'm Joseph Ariuslu from Sprott School of Business MBA currently. Thank you again for your comments. I'd like to ask specifically, Mr. Sprott, you brought up the mention of mistrained students or mistrained business school students. How do we, on behalf of our class, first know that we're mistrained or get a hint that we're being mistrained? Second, how do we take our education that we've invested in and hopefully build our careers on the best grounds possible?
I was very careful to say you weren't mistrained. I was talking about universities generally, okay?
Thank you.
But those universities that don't teach a multiplicity of economic theorems are the ones who are going to find themselves where their students are not adequately prepared. And as Ian and John have talked to, there are other schools other than the Keynesian school. The Keynesian school is not working, okay? It's a flawed, well, not so much that the Keynesian wouldn't work, but it's been misused by governments, where they just run deficits all the time. There never is a surplus. But there are other schools, as the Austrian School of Business, that should be studied, and the Kondratiev theory, and more. I don't think people should have this rosy view that economists are in charge all the time. They're not. They're not in charge, and the central bankers aren't in charge. It's just the flow of the economy is in charge. So I just think the courses have to be more pragmatic, and I'm sure yours has been very pragmatic too. So thank you for the question.
Okay, we have two last questioners with the microphone here. So if I'll ask you each to pose your question, and then we'll have the panel deal with both of them, and then we'll wrap up. So please go ahead.
Very good. Jason Daly, BCom 98, chapter president for Sprott alumni. Warm welcome, Eric. Nice to have you here.
Jason. Good to see you again, by the way.
Yes, likewise, thank you. I have a question to give a counterpoint to the discussion of precious metals and about the business and the economy of our future. Gentlemen, please comment on entrepreneurship. The biggest wealth generation is coming from entrepreneurial ventures, be the technology giants of today, Oracle, the Googles of the world. Tell us, will we find spring with entrepreneurship?
Okay, before we answer that, let's get our last question, and then we'll have the panel deal with both of them.
Okay. Joey Cardamone, graduate from Schulich, so a little competition here.
All together now.
No, I'm interested in gold as a yielding investment, as Sprott Inc. has been a great yielding investment. Do you think the large cap gold companies have the proper management in place to function themselves as a yielding investment and manage their company at the same time? And if not, will Sprott have a mining MBA?
Well,
let's have Eric deal with that one, then we'll come back and deal with entrepreneurship.
I think, like, I'm never a buyer of large cap gold stocks, okay, because they're always overvalued. And when I think Barrick, for the last 11 years, has done nothing. I think that. And maybe I'm wrong by 10 or 20%. But the index is up by 1,400%. When Barrick comes out and says that their production is going to go from 7.8 million to 9 million in 5 years, that's only 3% growth a year. I just mentioned I'm trying to buy stocks that can grow 100% in 2 years, not 3% each year for 5 years. So I'm never too turned on by the big guys. I think if you want to do a little scouting around, you'll find better value than the large cap gold stocks.
And finally, the question on entrepreneur and entrepreneurship.
Okay, well, I think there's, you know, I told you I'm the optimist here, right? I am. I mean, there's great opportunity, Jason. You know, as I said, I mean, every day I look in the paper for some opportunity, right? It's just as any entrepreneur can find something that people want, whether it's a service, a good, or whatever. And it's just a matter of systematically looking at what you can do and trying to get there. And you have to seize the moment. You got to be brave when you think you're there. You have to have sponsors and financiers, which you have to gather around you. But I think there's lots of opportunity for young people. Absolutely.
Just in the mid-1970s, it was pretty depressing. Richard Nixon had been impeached, and the U.S. looked like it was all finished. And you had the Google guys come along, and, well, Bill Gates, and then Steve Jobs, and that was tremendous entrepreneurial period. And again, together with this game plan, this 100-year game plan for this country, we have to stimulate entrepreneurship.
Agreed.
Because the high currency is bumping out all the manufacturers.
I would say the people are the precious metal in that case.
Yes.
Very good.
Good
Thank
one,
you.
Jason.
And on behalf of the audience, I'd like to thank the panel very much and turn things over to, I think, Jerry Tomerlin, Dean of the School.
Thanks so much, Chris. We're doing such a great job. Is this on?
Yep.
Yep.
Okay. And our panelists, Ian, John, Eric, fantastic job in sharing your insights into the economy and how in the world we get out of this. You know, I was thinking about this last night because I knew I was closing here, and I knew it wasn't going to be a sort of a glowing picture of our future. I'm thinking, okay, I'm going to be positive. And I am going to be positive because I have a lot of good things, a lot of positive things to say about Carleton. And the celebration that we're here today, we're celebrating the 10th anniversary of the donation to the school, the naming of the Sprott School of Business, and Eric, your donation to supporting students throughout the university. It's a fantastic story, and I'm really pleased that you've come here. You know, Carleton in general and Sprott School of Business specifically is an engaged community. We're engaged as a community of scholars, but unlike many universities, we know that the real world is out there, and having a good forum like this one where we bring in people from the real world is going to inform our students, inform us in our research, and also connect us ourselves to the community. So it's very important, and that's what we believe in as a university, and we believe in as a business school, certainly. We've talked a little bit about some of the positive things that we have to look forward to. I know it could be a long slog if it's going to be 20 years for recovery, but that can't stop us from going on, and that's what we're going to continue to do. We believe here at the Sprott School of Business in collaboration with partners and with creativity. I think that's how we're going to continue. So just a few examples as we talk about. First one we've just talked about. Jason, you opened up the discussion a little bit. We have new programs in entrepreneurship. Roseanne, you mentioned this in the beginning. We have an entrepreneurship within the Bachelor of Commerce program as a concentration, but I think the key factor of that is that's a minor in entrepreneurship for the rest of the university, because I think for us to make a good contribution and to build a brighter future, in the end of the day, it's going to require creative ideas and ideation coming from all kinds of sectors. And so as a business school, we want to play our role in that, in helping that happen. You know, some years ago, about 15 years ago, we introduced Bachelor of International Business, very creative program. Has been copied somewhat, tried to be copied by other institutions, but still none of them are exactly the same, incorporating the acquisition of language acquisition along with the study of business and a required study abroad, very creative. And I would just like to say, going back to perhaps that we should be looking east, that we do have a number of students, in fact, who are studying Mandarin, studying Japanese, and spending their year abroad. in what I think is very challenging for people with an Anglophone background to pick up the language and be fluent in Mandarin and Japanese and other Eastern languages. We also have a new creative partnership with the Norman Patterson School of International Affairs. So some of our MBA students that are here are in fact in the new International Development Management option, and they're going out and I think doing a great job in terms of engaging with that community and looking at bringing a management focus, a business focus to the challenges in international development. And it's just so many of these things that we can do only with this kind of contribution. One last one I want to talk about is a collaboration with the engineering and design that we have, which is also a program that's been around for quite a while, the Technology Innovation Management Program, which is a master's program. Is also a program that's all about ideas and bringing ideas to commercialization and actually making a difference in the world. So that's part of the DNA of this school, and I just want to emphasize that your contribution makes this happen. We wouldn't be able to do it without it. Another one that we're talking to some students right after this are the students who are managing a fund. They actually do believe in, I think, diversification, and so I think they can't wait until the session that we're going to have right after this one, where we're going to have a discussion. And that real-world experience for our students could not happen without this donation. So thank you so much for doing that. So many things happening today. I just want to close by saying thanks so much to John and Ian and Eric. And there is a positive side. This is we've often had speaker series from the outside, but we've actually launched a new series. We haven't even talked about it right now, called the CXO series, of bringing in chief officers from industry. And this is the inaugural speech for our MBA students and for the business school at large, and we look forward to a lot of this in the future. And thank you so much, gentlemen, for being here.